And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Tuesday, which means it's Two Dads on Money. And of course, we're going to get into a little bit about kind of a midlife crisis, money flaws that happen. John's in the middle of one right now. So we're going to talk about real life experience. Also, whether or not you should borrow from a 401k plan. Gen Zs right now. The reason we're going to talk about this today, important, is that Gen Zs in particular are tapping 401k plans at some of the highest rates on record that we've seen historically. So again, the thesis is, hey, I'm just borrowing from myself, but is it really just borrowing from yourself, and is it really a good idea? So we'll talk a little bit about that this morning too. There's quite a few little pitfalls that you fall into with that. But most importantly, let's not forget the big news for today. Today is Taco Tuesday, right? And it's also National Taco Day today. Coincidence? I think not. But there's only 3 types of tacos, right? You know what the 3 types of tacos are, Brent?
I am waiting.
You're waiting?
Yes.
Licking your chops, deliciously waiting? 3 types of tacos. Crunchy tacos, right?
Yeah.
Which I'm not sure those aren't, that's kind of an adaptation of the real taco, which is the soft taco.
Well, they only stay crunchy for a while.
Well, that's true.
So,
but soft tacos are the original taco,
Yes.
right? Can't go wrong with those, especially on corn or flour tortillas. Mm-hmm. I mean, it just depends on what you like there. The third type of taco is Jack in the Box tacos, which are, they don't really classify as a traditional taco, but at 2 o'clock in the morning after a hard night of drinking.
Don't those show up on the periodic table of the elements?
I'm sure they do,
Yeah.
in the clog your artery category of elements. But yes, anyway, today is National Taco Day, nonetheless. All right, let's talk about some serious stuff this morning. The government shutdown continues, unfortunately, but again, everything seems to be going just fine. Nobody really cares at this point. Markets are continuing to do very well. Hasn't been any real impact. The dollar has strengthened over the last couple of trading days, even though the government's been shut down. So for all the angst, and we talked about this going into the actual shutdown, it's like, hey, these things don't really mean a lot to markets, and it certainly hasn't. Markets continue to do well. And as we talked about yesterday, it really doesn't matter what asset class that you own right now. If you own stocks, you're making all-time highs. If you own gold, you're making all-time highs. You own Bitcoin, you're making all-time highs. The most shorted stocks are making all-time highs. The lowest quality stocks are making all-time highs. In fact, the only stocks that really aren't making all-time highs right now are quality defensive names. Outside of that, if you're into the speculative risk mode, transactional type activity, you're making money in this market. And again, if you go to our SimpleVisor page, simplevisor.com, and look at the portfolios that we've provided there, we've got several thematic portfolios that act like kind of factors for the markets, and the small cap, mid cap index, the crypto model, the AI models, all those models, the all weather model, which is just a very conservative model. Just launched those portfolios in August, and those are all up, high single to double digits now. And again, doing very, very well here because this whole market is just kind of dragging every asset up with it, no matter kind of really what you own. Of course, as we've talked about before, there's a consequence to that, which means that eventually, when this ends, if it ever does, they'll all go down at the same time as well. So again, just something this is why we keep talking about risk management. Enjoy the ride here, very important. Markets are going up, but don't forget there is another side to this eventually. Just keep paying attention to that. But overall, as I said, everything's fine. Here's what you need to know before the bell this morning. Markets are going to open a little bit higher this morning, kind of flattish right now. We'll see kind of what happens as we get closer to the open. But markets set a new all-time record yesterday, up about 40 basis points by the end of the day. Again, just continue to develop, as we talked about yesterday, these very large gaps above the long-term moving averages. Those are very, very hard to sustain longer term. If we take a longer term look at the market, so as an example, just go back, this is a 3-year chart. But you can see that just essentially every time that markets get very, very deviated above these long-term moving averages, and again, it's just a function of time, you're eventually going to get corrective action. So again, you've got a very, very significant gap above the 200-day moving average right now, which just suggests that while the market continued to rise here for a while, you're eventually going to get a reversion back to that, that moving average. That's just kind of the nature of the markets and how they work, and it's kind of just an undeniable factor. You just cannot stay above the 200-day moving average indefinitely because it wouldn't be an average. The reason that the 200-day moving average is an average is because of these periods like April where you have a very big declination below the moving average, which tends to hurt a lot. And as we talked about yesterday, in particular, if you didn't watch the show yesterday, we went into bear market losses and talking about percentage losses and what they actually mean in terms of the effect on the compounding of your portfolio. These drawdowns have very significant impacts to how your portfolio performs. But more importantly, what we didn't cover yesterday is the psychological factors that occur during these drawdowns. This is where investors, they're buying high, they're chasing markets like we have right now. It's, I can't go wrong. I just buy something and it just goes up. It doesn't matter the quality of the stock. Again, lowest quality stocks right now are having some of the biggest gains. Stocks with no earnings, low profitability. If you take a look at the small cap index as an example, I just posted a chart of this on Twitter this morning. Take a look at that at low quality, small cap stocks with no profitability. Those are the ones doing the best. And if you actually take a look at the Russell 2000, after you pay taxes and interest payments, there is no income growth for the Russell 2000 index. But those are the stocks that are performing very well right now because of this speculative chase. But again, just understand that when that decline comes, yes, I can chase those assets. Everything's great. And I know right now, just throw money at it. It just goes up. You're making money hand over fist. Just remember that eventually this will end. And during that decline, that's when we tend to panic sell. That emotional bias kicks in. We tend to sell at the wrong time, and we destroy those gains. And so this is why we talk about this process of just taking some profits, rebalancing portfolios, rebalancing risk, strategic rebalancing, as we talked about yesterday. That helps maintain those gains, build some cash reserves, so on these declines, when they occur, you can put that capital to work. Let me run through a couple of markets here real quick with you this morning, just to kind of run you around the mill. If my computer would work for me, it would be really great this morning. Like I said, small cap index, this is the Russell 2000 hitting an all-time high. Again, significant deviations there. Small cap index, this is just pure S&P 500 small caps. Those are also ringing up at all-time highs, triggering a buy signal right now. Some of the biggest gainers right now, this is international, developed international stocks. Doing very, very well here. We've had very sharp gains here over the last 5 days. Huge deviation above the 200-day moving average. Again, extremely overbought on a relative strength basis as well. Emerging markets also looking very much the same thing across the board. Again, as I said, you just kind of keep seeing the same chart over and over again. The U.S. dollar, though, this is something that you need to pay close attention to because we've been seeing a rising trend in the dollar here. Very long basing period, still in this base, haven't broken out yet. But there is a long-term correlation between a stronger dollar and what happens to other asset classes. Particularly, we've got really big gaps right now between the dollar and things like the U.S. Treasury, things like the market itself. So again, watch this dollar. This is going to be a key if we start to see a much stronger dollar rally here. And again, a dollar rally back to 101 would be the 200-day moving average right now. That is not out of the cards. And again, if you take a look at a longer-term picture of the dollar, we've been basing here for quite a bit, and that's okay here. But again, we've been in the space. We broke this bottom long-term base here, been basing here. So a rally back to 100 to 104 is very likely. That's going to put some pressure on dollar-related assets. So again, keep a watch on the dollar here. This is the one thing that could be the surprise kind of in the soup for this rally as we head into year end. That's what you need to know before the bell this morning. All right, we'll come back, pick up with John Penn, talk a little bit about midlife crisis mistakes that we make with money, and also why you should or should not borrow from your 401k plan. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candy Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Morning, John. How are you?
Good. Good morning.
Good. All right. So, got a few things to get into. I know you're having a midlife crisis right now.
Right now.
Don't know why.
Don't know why. Just not as young as I was. Starting to panic.
No. It's so funny because everybody talks about the midlife crisis, and you go out and you buy a sports car or whatever.
Oh yeah, I didn't tell you I pulled up in a Hellcat this morning.
Oh, nice.
All my neighbors are buying them, so why not, right?
Exactly. Everybody's going through the same thing right now. But no, yeah, I never actually went through one, so I've never had that midlife crisis point. Maybe I'll have one late in life. Maybe I have a late life crisis.
Yeah.
So it could be the case.
Well, I mean, I'm only 30, so I still have some time, right?
Only 30.
That's right.
We're all younger than we feel.
That's it.
Or we feel younger than we are.
We feel younger than we are.
There we go. There you
Yeah.
go. So, all right, well, let's talk about some of these things. So, again, we kind of reach, it's kind of interesting. So, as I was talking about yesterday, I went through bear market losses, and, this is one of those charts that gets run around a lot. First Trust originally created, and they showed the long-term history of the markets and these, percentage drawdowns. You say, yeah, bull markets, on a percentage basis, they just massively dwarf, the bear markets. Don't worry about the bear markets. Of course, when you actually look at it in terms of dollar loss, it's a very, very different story.
Yeah.
But what's important is that we don't have a lot of time. And this is the one thing everybody forgets. Is like, oh, just look at the long-term chart of the market. It always goes up. It always slants up at a 45-degree angle to the right. Just, put your money in the markets. It's fine. Problem is you don't live 125 years. So we all have a finite lifespan, and for most of us, we don't even get really started investing until we're in our mid-30s. Fortunately, one thing about what's happened over the last few years is because of things like Robinhood, because of things like more access to the to kind of the financial information, social media. In particular, we do see a lot of younger people now starting to get involved in investing. Unfortunately, they're speculating, not really investing. They're more gambling, but at least they're getting started younger,
yes.
Right? So it's a good thing. But the question is that again, when we start getting into our serious saving and investing years, where now we've got income growth, we've got excess income, we've got kids out of the house potentially, and we really can focus on putting a lot of money away. This is also kind of the point to where we start making a lot of mistakes.
Yeah, I think there's a point in your life when you're younger, especially if you're raising a family, you're just trying to make ends meet for a while, right?
Yeah.
You're in that. You've got all these different goals going on at the same time, but one of those might be with your kids, depending upon what your goals are with college, making sure there's money set aside for them, weddings, etc. And then maybe at some point they finally fly the nest, right? Well, then hey, now what am I going to do? And I see that when we're helping people plan, where initially it's about saving for college, making sure everything's taking care of the kids, and then kids are out of the house. It's like, hey, John, well now I need to make sure that, hey, we're taking care of ourselves, so that way we don't become a burden to our kids, right? And then it focuses on what can we do to maximize our savings and our returns, so that way we can really focus on. I think there's a big focus, Lance, on as we get older, just the higher cost of medical care. Right, so things that we need to start thinking about when kids start flying the nest a little bit here too, right? So it's just amazing how we kind of there's kind of like two opposite ends of the spectrum. We're saving when we're young, we're just trying to make ends meet, and as we get a little bit older, we're kind of getting into those prime earning years. We want to make sure that we're not going to become a burden to the kids that just left the nest, right?
Right.
And how do we juggle all this?
Right. No, and again, it's one of the big things that happens, and most of the people that I sit down with and talk to is when you're younger, right, you're just struggling to make ends meet,
Right.
and so you're living a normal lifestyle, kind of speaking,
Yeah.
As such, right? So you got your apartment, you got your townhouse, whatever it is, you've got your car, and you're raising your family, making ends meet. And then as you start making more money, you go, well, but I need a nicer car. Oh, now I need a nicer house. No, now I need to live in a better neighborhood. And those are all, there's nothing wrong with that, mind you. There's nothing wrong with that at all. But what you have to be careful of is you don't let that lifestyle creep occur to where you're constantly just making ends meet. And
Right.
and I tell you what, I run into a lot of individuals, and they have, they live in a very nice house, they have very nice cars, they have, they got kids going to college and do it, and you think they're doing exceptionally well, and then they'll pull me aside at a party. It's like, hey man, this market's really going up a lot, but I don't have any money to invest, right?
Yeah.
And so you start talking about, okay, well, where we are, and I think I don't know if you've seen this lately. There's a new company that's running around on social media called Simplify. Have you seen this?
I have seen it.
Okay, and so on TikTok right now in particular, there's a lot of ads where they're sitting in front of a computer and they're applying for a $100,000 loan for Simplify. Because and so the ad is this. This is the ad. My boyfriend, girlfriend, whatever it was drowning in debt until they applied to Simplify and got a $100,000 loan. Wait a minute. You were drowning in debt, so now you just took out $100,000 in debt.
Just take out more.
Just to add to your pile of debt, and so look, I get it. You're supposed to be consolidating your debt, right? So you're going to apply to Simplify, take $100,000 to pay off your credit card debt. Fine, but the problem is most people don't do that. They just add to the debt pile. And this is the thing I run into a lot of the individuals. They look like they're living this fantastic lifestyle, and it's great, but when you actually start digging into the weeds a bit, it doesn't take long to reveal that there's a lot of debt, a lot of leverage onto the system, and that's just a function that lifestyle creep has just eaten into that ability to save and invest.
Yeah, it's as we're working with folks as we get a little bit older and we're working with folks from a financial planning standpoint, sometimes it is not uncommon for somebody to say, you know what, John, when I was younger and I really wasn't earning as much, I knew exactly where I spent every penny. Like I knew exactly where all my money went. And now that I'm older.
I did too, before I got married.
Oh, okay.
Yeah. So.
Uh-oh.
Well, no, I still know where it all goes, Brent. It all goes to Amazon. But
It's that Amazon budget.
But I was like John, when I was single, I had a spreadsheet. I knew where every penny went. I knew where everything was. And then I got married, and I just go for it.
It's all yours, honey.
Yeah.
I feel
That's right.
you, brother.
It all winds up in her bucket at the end of the day. So,
That's right. It's like, what are these boxes doing on the front porch again? It's like, what is going on with these boxes smiling at me?
I don't know about Shauna, but my wife, first name basis with the FedEx delivery guy.
Oh.
I mean, he comes up, he's like, "Hi, Christina." I'm like, "Here's your box." Oh, guess what showed up yesterday?
Halloween decorations?
No, Halloween's already decorated.
Oh, I'm sorry.
Yeah.
Thanksgiving
Christmas.
decorations.
No, Christmas decorations have started showing up by Amazon. So.
Well, hold on. Valentine's Day's just around the corner.
I know, right? But she's not a big Valentine's Day girl. So
Lucky for you.
Yeah. She's not a big Valentine's Day girl. We go to dinner, that type of thing. But no, it's the major holidays. It's Halloween, it's Thanksgiving, it's Christmas, Easter.
So
right?
what'd she get?
What did she get for Christmas?
Yes.
So
Yesterday's delivery.
So she has
yesterday's shipment.
And the problem is now she has cancer. I can't say no, right? Because now she throws out the cancer card every time I turn around. So it's like, I have cancer. I'm like, okay, fine, whatever. But no, so she has a Nutcracker fetish.
Oh.
Yeah. So Nutcrackers have now started showing up at the house, and these are not little Nutcrackers. Yeah, these are like 4 foot tall Nutcrackers to go by the front door.
Or life size.
Yeah.
They're intimidating.
Which they are intimidating.
They're intimidating.
Yeah. Also reminds you, also says a lot about my wife. So.
I'm just going to pop some popcorn and sit back and just enjoy this.
We maybe need to film an episode at your house.
So, but anyway, I digress. I'm having mission creep in our discussion.
It's Amazon creep,
yes,
right?
Exactly.
But you see it. So now that we get a little bit older, it's not uncommon where I'm visiting with folks who are like, "Hey, John, now I'm making more money. I have no idea where it goes, right? And so let's help you take a look at your budget." And I think sometimes one of the pitfalls or one of the money traps, here that we see is as you earn more, as you get raises, as your income grows, well then your standard of your living expenses, your lifestyle, it creeps along with it. A very common practice that I find with folks who, as their sources of income increase, they pay themselves first, right? As their income increases, they take that and they put that into their savings. They really want to maximize all of their various savings vehicles, right? After all of their savings vehicles are maximized. 401ks, maybe it's pre-tax, maybe it's Roth 401k, health savings accounts. Maybe they're putting money into cash value life insurance, whatever it might be. They are as their income grows, they are paying themselves first. And then whatever's left, that's what they use to help increase their lifestyle. But I find that if folks aren't paying themselves first, then as their money grows, like you said, it's just one Amazon box after another, right? And you don't see, you don't enjoy the increase of your income because it's being spent everywhere, right?
Well, and we've talked about leakage before, which
Leakage,
which is important. I mean, well, again, it's the $5 Starbucks, right? It's like, it's just Starbucks, right? But it's every single day, and it's $25 a week, or $30 a week, whatever it is. Mm-hmm. And then that's every week. And so when you start adding this stuff, and again, it doesn't, these seem like little small things. And now it's even getting worse, right? Because of DoorDash and Grubhub and these. It's like, oh man, I'm just too tired to cook tonight. I'll just DoorDash something. Well, all of a sudden, a $40 meal is $55 with delivery fees, and it's like, okay, yeah, it's this time. But then if you go back, and my wife and I did this, and we stopped eating out a lot. We really cut back because it is simply a function that we started adding up how much we spent eating out. And it was like, that's crazy.
Yeah.
And we don't eat at fancy restaurants at all, right? It's just, but try to go out just even, especially with 4 kids. But you take out 4 kids when they come home for whatever, and it's like, $400, $500 to feed them. Because, I miss the days my kids were little and you could feed them a Happy Meal.
Oh, yeah.
Yeah, no, now my son's like, yeah, I'll have 6 tomahawks and a ribeye for an appetizer, and then we'll order dinner. But it gets really expensive. And so you start adding that stuff up and go, man, I have just spent so much money on this leakage that just goes out, because we don't think about it at the time because it's just these small one-off events. But you add those up over the course of a year, it's a lot of money.
It's a big number. Meal prep, I'm telling you, meal prep, it helps. I'm not saying don't go out to eat every once in a while. Right. Shauna and I, we do the same thing. Maybe once a week, we'll go out to dinner, and it's nothing like overly extravagant. But and plus the portions around here are massive. So my wife's not a huge eater, so we'll usually get an appetizer, share a main dish, and that's plenty for us, right? So I'm pretty fortunate there. But even that, just doing that, going out once a week, we looked at that too, and it's like that gets to be pretty pricey too. So we try to reel that back, right?
Yeah.
So something else too that I find that I think as investors, as we get a little bit older towards that midlife crisis range too, Lance, is when it comes to the investment portfolio, we tend to kind of keep throwing money at whatever's doing well, and we sometimes we get more of a concentrated portfolio versus taking a more active approach, or not diversifying your portfolio adequately. So sometimes I find that folks become too concentrated in any one given area. When that area is doing well, it's great, but then you were just talking about drawdowns, how that can just quickly destroy wealth very quickly, right?
Yep.
So just make sure that you're not overly concentrating. I remember the days of Enron. I mean, it seems like it was yesterday. You just never know. Any well-run company, you just never know. So just don't put all of your money into one stock, or start to diversify away, especially if you have an employer stock. A lot of the clients that I visit with that have concentrated positions with their employer stock, they're very disciplined about just trimming that and shaping that down over time, and they diversify that money into other areas, into a more broad-based, diversified portfolio.
Yeah, there's some rules around company stock that we can get into sometime. But one of the other things is that I see a lot of people get themselves into, and this is always the story I get up front, which is I use credit cards for the points.
Oh yeah.
And it's like, I'd spend on this credit card and I get all the points, and it's great, it's fantastic. And as long as you're paying that off at the end of the month, it's great. The problem is once you start getting behind on those payments and it starts to snowball, and that's, one of the, and this is again, this goes back to kind of the age that we live in now, whether it's, buy now, pay later. Walmart's just now introducing their own version of buy now, pay later. Can't imagine what's going to go wrong with that one. But, we got buy now, pay later. You've got credit card debts. You've got all these other kind of, and then like these new companies coming out, Simplify, where they'll just give you loans. Accessing debt. This is one of the reasons we've talked about before. You never count the consumer out. When the consumer looks like they're tapped out, they have an amazing ability to find more money to spend, and they keep the economy kind of running along. But this is just kind of a function that also creeps into that lifestyle. Again, it's like I was saying earlier, a lot of these people that you meet that have these fantastic lifestyles, and it's just like, man, they're traveling all the time, they're going to Disney, they're doing all these type of things. And it's like, but you actually, when they actually eventually say, hey, I need some help with this, you start getting into this, and by and large, they have a ton of credit card debt. And it's like, why do you have so much credit card debt? Well, I was doing this for the points, and then we had this event happened, and then I got behind, and then this other event happened. And like we talked about before, life always shows up, no matter how good your plan is. Oh, my plan is I'm going to pay off this event every month, whatever it is. And then life happens. And you don't have that emergency fund. You don't have the savings set aside so that you can make up that gap. And then once you get behind that curve, it's very, very difficult to get back out of it again.
Yeah. So if you think about this, right? So today I was looking at this before our discussion this morning. So just today, the average rate on credit cards, and I think this might be a little bit low, but the average rate on credit cards, depending on the card, is somewhere between 20 to 25% on the balances that you carry.
There's definitely some that are higher.
I've seen some that are in the high 20s, maybe getting close to 30%, right? So for the younger generation that's out there listening, let's say if you carry whatever balance is on your credit card, $5,000, $10,000 on your credit card, and you're just making the minimum payments on that just to avoid more interest or more late charges. I mean, you're gonna be getting charged interest the whole way through, right? That's what the credit card wants you to do. They want you to carry a balance, and they enjoy charging you 20, 25, 29, 30% on your balances. But I was looking at this morning. If you have a credit card where you have like a $5,000 balance, $10,000 balance, and you're just making the minimum payments, and assuming you don't put anything else on the card, right? You're just making those minimum payments. It's going to take you close to 30 years to pay that balance off. And think about that 30-year span where you're just making minimum payments on a credit card. Those are dollars that you could be using to grow your wealth instead, right? So if there are younger investors out there and you say, oh, Lance, John, I only have $5,000 on my credit card, I only have $10,000 on my credit card, whatever the balance is, if you're just making the minimum payments, it's going to take you an incredibly long period of time to pay that off, and that is money that could be used elsewhere, right? To set yourself up to have to be in just a more financially flexible state as you get older, right? So just watch for that. And you were talking about the buy now, pay later. Yep. I think when buy now, pay later came out, I really think it was intended for, I think it could be used for like life emergencies. Like if there was a big time expense that you just couldn't plan for and you needed to make a payment or pay that off in a couple of installments and make those payments on time and not be subject to any sort of penalties or late fees. But unfortunately, now we're seeing those buy now, pay later plans being used for groceries, living, daily, necessities. I mean, there are folks out there, getting their Dysport, Botox, all of their, their wrinkles removed, and then they're using buy now, pay later. Is that really what that was intended for?
No.
Right. So it's all about, try to avoid putting yourself into a situation where you're just paying interest, making minimum payments, because again, those high interest credit card debt, it's just going to take you forever to pay those off. Just a really long period of time.
Yeah, this is the thing I don't understand about credit card companies, how they get away with it, because again, so I do hard money lending as one of my side hobbies.
Yeah.
And those rates are pretty much capped, where when you're doing a hard money loan, you can charge 10, 11% interest on a hard money loan, maybe 12. But you get much beyond that, you get into what's called usury. And if you're charging a 25% interest rate for a hard money loan, unless you're working for the mob and it's off the books, you can get sued by your borrower and it goes to court, and they'll say, well, that's a usury fee, and they'll basically kick that whole loan, right? So you got to be really careful with that. And it's interesting though that credit card companies have gotten around usury fees, and they can charge 20. I mean, it's criminal to charge that rate, right? I mean, it really shouldn't be charging 20. I've seen credit cards as high as 32.
Oh yeah.
So when you're charging that rate, you simply cannot get ahead of the curve. Right. It's just, there's no way. And when you're paying minimum payments, you're going to be locked, like you said, locked into that for 30 or 40 years before you ever get that paid off.
Your credit card companies will love you if you're just making minimum payments.
And by the way, just really quick, we've talked about this before. The biggest lie out there is that you need a credit card to build credit. That's an absolute lie. That's a lie promoted by the banks that want to give you a credit card. You do not need a credit card to build credit. Yeah. So don't fall into that trap.
Yeah, and Lance, you brought up a point earlier about, as you're maybe visiting with folks and they say, hey, I don't have any money to invest, or I don't have any sort of cash on the sidelines to, take care of opportunities. A lot of that goes into, just having an emergency fund. So that way you don't have to rely on high interest credit cards to, replace an air conditioner or vehicle repair or whatever that might be, right? And so I think in times like this, for those who do have money invested, and if you do have some money concentrated in certain areas, something that comes to mind this year, maybe gold or who knows, cryptocurrencies, take some profits, right? Take some profits along the way and refill your cash bucket, refill that emergency fund, especially as you get a little bit older. When you kind of get to that midlife range, when you're young and you're working and just making ends meet, you want to have maybe a good 3 to 6 months, if you can, of living expenses set aside. But as we get a little bit older, we get closer to those years where we're approaching retirement, or we want to work a little bit less, whatever that looks like. I like to see folks have maybe a year, maybe a little bit more, maybe 18 months worth of living expenses set off to the side. So that way, hey, if markets get a little bit get a little volatile, you're not having to be forced to sell investments at an inopportune time to raise cash for whatever life throws at you. You have plenty of cash reserves set aside, so that if your portfolio should get a little volatile, that gives you time for the assets in your portfolio to recover. So there's a lot of folks who have gold miners or certain asset classes this year that have responded and done very well this year, that have not done very well in the past. And my tip is just, hey, take some profits along the way and refill your cash bucket. Right, so that way you've got that cash there in case you get into a little bit more trying time.
But it's so much fun. It just goes up every day.
It never goes down. It can't go down, right?
It just goes up every day.
That's right.
And it's so much fun. But this is also part of, be really careful. One thing that I see running around a lot right now is, especially on social media, is 26 days to trade your way to wealth, and all these kind of get rich quick schemes using financial markets. Again, most of this stuff that's coming out is from people that have actually never been through a bear market. The article I wrote yesterday talking about bear market drawdowns was written by a guy who started in the investing world in 2011. So has never been through a bear market, has never actually seen what a bear market does, a real bear market does to investor psychology and to portfolios over time when it occurs. And so it's easy to write stuff when you don't have any real concept of going through an actual bear market. And right now there's a ton of get-rich-quick schemes. Trade your way to wealth. The stuff that's going on in the markets right now, in terms of investing in crypto or trading stocks or buying these dollar stocks, and this stock's trading at 75 cents. It's going to go to $20, right? It may. But this is the exact same stuff that we saw in late 1999. We talked about before about the trading rooms. People would just lease out entire floors of high rises and put in computers and allow people to come in and trade stocks. And it was great until it all fell apart. And so again, you got to be careful when there's some very basic rules of investing and growing your wealth that are tried and true over time, and they survive the decades. What's going on in the markets right now will not survive the decade. There will be a downturn in this market of significance within the next decade. It's just a function of when it occurs. Now, a decade's a long time, it's 10 years. So, I mean, this thing could rally for another couple of years. But within the next decade, you're going to have a very serious financial consequence in the markets because speculation will eventually reverse. And that's why these long-term trading rules, and again, I told you yesterday, I started writing this yesterday, but I've gone back and I've gotten 7 or 8 of the world's greatest investors throughout history. I'm just putting all their rules and their trading rules into one chart, one article. So you'll just have like a desk reference of all these rules. And, when you look at those rules, not one of them ever say buy and hold, and not one of them ever say speculate in stocks, right? I mean, it's all about managing risk, controlling outcomes, those type of things, because that's how you survive the long game. And so, falling for these get-rich-quick schemes, these trading, like these programs that are promoting trading schools, 28 days to trade, this, that, and the other thing. It works when the market's just everything's melting up, and they are happy to take money from you to do that. But they don't care when the market's going to turn lower. They're not going to come back and say, oh, you need to sell everything. They're not going to be there when you need them, right? You're going to have to rely on your own capabilities to navigate the downturn in the market when it comes, right? And again, I'm not saying it's going to come today, tomorrow, next week, next month, next year. But when it eventually comes, you've got to be able to navigate that. And the problem with these get-rich-quick schemes you will get rich quick, and then you will also get broke quick too. Yeah,
and I think a lot of this ties into another concern that I hear on a regular basis is I think folks are very concerned about inflation and how that affects their future purchasing power. And I think, but at the same time, I think folks, as we get a little bit older, maybe if we've been, sitting in cash or earning some really nice attractive interest rates as of late, T-bill and chill was working pretty well there for a while. But now, short-term interest rates are starting to come down, and I think more folks are expressing to me that they are concerned about, inflation and the erosion of their future purchasing power. But at the same time, Lance, I think they're a little leery of investing in equities. Yeah. And I think sometimes investors feel this has to be an all or nothing decision. It's like they got to be all in or all out, and that is not the case. You were just talking about managing risk, helping to manage your outcome, right? All these, get-rich-quick schemes. What you really need to figure out is what is the rate of return that you need for your situation, not your neighbors, not other family members. You need to figure out what is that hurdle rate that you need for your future to be successful so that your finances can support the next chapters of your life. And we call that a hurdle rate. What is that rate of return that you need? So that way you can, fight inflation, keep your purchasing power and do the things that you want to do, but that doesn't mean you need to have a portfolio that's 100% in stocks, right? So if don't let, fear of volatility in the markets prevent you from investing, so that way you are setting yourself up for, long-term success, but at the same time, it doesn't need to be an all or none decision either.
That's right. That's right. So again, just these are some things that just John and I have worked with literally thousands of people over the last 25, 30 years that we've been in doing this, and it's always interesting. When I go back and I think about the people I saw in 2001 and 2, right? All the consequences were the same. They were speculating, taking on credit card debt, doing all this type of stuff to chase markets that were literally just melting up. And it didn't matter what asset class you bought, it all went up, everybody was happy, and it all came tumbling down. The outcomes are always the same. And everybody thinks that they've got it under control and that they understand what they're doing, but really it's just a function that markets are making you appear to be smarter than you actually are. And this will eventually have a negative outcome financially for you. So if you're not using this opportunity to shore up your financial backdrop, right? Use this market rally to take some profits and pay off credit card debts. Get debt free. I mean, if you're making a lot of money in the markets right now, get debt free. Yeah. Right? And now, when you talk about getting debt free, I'm talking about credit cards, I'm talking about car loans, those type of things. Don't worry about paying off your mortgage. If you got a 3% mortgage, just keep your mortgage. 3% is a cheap rate. But because you're always going to have a house note too. Great, you've got a paid off mortgage. Now you've got dead money because your house is paid off. But the only way you can recapture that money out of the house is to sell it, but then you've got to go buy something else, right? So don't worry about paying off your mortgage. Being debt-free doesn't mean having no mortgage. It doesn't really make that big of a difference. But definitely get out of credit card debt. Definitely use this opportunity of capital growth to clean up some of that backdrop. So when the eventuality does come, and you have to sell assets and start doing other stuff in the financial markets because of the eventual downturn, you're not also saddled at the same time with having to make a lot of credit card debt, car loans, those type of things.
Yeah, I mean, and there is good debt, right? There are ways to use debt or to use credit to your advantage, right? But then what we're really talking about here is avoiding the bad debt, right? That really high, those interest card, credit card balances, et cetera. But there are good ways to use credit to enhance your financial future. Right?
If you're buying rental properties or income producing rental properties, et cetera, you absolutely want to use leverage for that. It's fantastic, right? But again, we're talking about the average person,
right,
that, who's just saddled with a mortgage payment, credit, auto loan pay. They've got 4 cars, and it's 2 people in the house. They got 4 cars in the driveway. Why? Right? You've got 16 credit cards. Why? What are you doing? And so this is just a really good time to kind of reassess. Use this market advance, use this wealth that's being created in the markets to clean up all those backdrops that you've got going on that potentially are going to hurt you when the market turns down. Because again, if you don't clean that up now, when the market eventually downturns, and it will, and you're losing value of those assets, you're still going to be saddled with that debt that you've got to deal with, and you'll regret not having it taken out. Man, I could have paid that off. You should have.
Agreed.
Yeah. Let's switch gears here real quick to get ready to wrap up. This won't take but a second, but I was talking about this. Gen Zs right now are tapping their 401k plans to take out loans to make ends meet, and I get it, right? So what's going on in the economy? It's a terrible idea. It's promoted as this idea that you're just borrowing from yourself and you get a cheaper rate than borrowing from the bank or whatever it is. That's the pro side of it. It's like, it's easy, right? I just do a quick application. I get money out of my 401k plan. I'm just borrowing money from myself. It sounds easy. It sounds great. It's a huge trap that you get yourselves into, and you actually impair the one thing you're trying to grow for your retirement, which is that 401k plan. And again, out of all your assets, the one thing you should not speculate with is your 401k plan at work or your IRA. Those are your retirement vehicles. You need to make sure you're investing in a manner that those are going to survive market downturns. You need to be more conservative with that, contribute to it regularly, make sure you're doing what you need to do to get that to your financial goal. But at the end of the day, if you screw up, if you're taking all your investment speculation risk in your taxable account, and that goes to zero at some point, at least you have your retirement secure, right? And so, doing things that impair that facility has a very long-term impact to your ability to retire. And borrowing that money from your 401k plan is a big negative impact to that future outcome.
Yeah, I think so. I think with traditional IRAs, Roth IRAs, but specifically here we're talking about taking a loan against a 401k plan. I mean, you want to set these accounts up to be growth oriented, right? So that way that especially in a if it's a pre-tax 401k, that money's growing tax deferred. If it's a Roth 401k, that money is growing tax free. But I think what you don't want to do is you don't want to treat your 401k plan like it's an emergency fund. That is not what it's for, right? It is for long-term growth, where, like Lance said, this is something that you're contributing to on a regular basis. If markets go up, you're just buying a little less shares. If markets go down, guess what? They're on sale. You're buying more. But if you really want to avoid taking a loan against your 401k plan, just don't treat it like an emergency fund. But I think that's more of a trend that we're seeing, especially with the younger investors right now, right? It's just easy. I don't have to fill out an application. There's no credit check. I'm borrowing it for myself. I'm paying back my interest. Hey, I don't want to pay 29 or 30% to my credit card. I looked at the average interest rate on what a 401k loan would charge. It's prime plus maybe 1% to 2%. So you're probably in that 8, 9, 10% range, right? Just to borrow from your 401k plan.
But that's where the problems come in, because once you draw that money out of your 401k plan, you've now undermined the compounding effect of the plan, because that loan is sitting there and it's not growing with your portfolio. So you've now taken that money out, and you've now started to slow down that compounding process of your 401k plan of allowing it to grow over time.
Right, and if you're carrying a balance on your 401k, and let's say something happens with your employer, either you leave, you're let go, whatever that is, and you've got this outstanding balance, and you try to move that plan to a different employer, or you try to move that 401k plan to your IRA, chances are before you move those dollars, your previous 401k plan is going to want you to pay off that loan, right? So that's
and that's not an option in a lot of cases.
That's not an option in a lot of cases. Plus, here's what I think a lot of folks don't realize is when you're making those payments to pay off that 401k loan, the payments you're paying tax. This is after tax, so you pay tax on the payments that you're using to pay the 401k loan. That money goes back into your 401k, and this is all pre-tax dollars. At some point when they take the money out, you're going to get taxed again, so you're getting taxed twice, right? Yep. So again, I really, if versus taking a loan from a 401k plan, I would really focus on budget. Where can you trim? I'd rather focus on budget items. Where can you trim, cut back on expenses to free up some additional cash flow to maybe pay off debt or take care of other financial emergencies that might be going on. For all the reasons that Lance mentioned, I think probably borrowing against a 401k plan, just don't treat it like it's an emergency fund.
No, and look, this is why simply it should not even be an option.
Right.
I think, look, honestly, the IRS should withdraw the rule. They should not even make it like, for instance, if you want to go to the bank and borrow money, you cannot borrow against your IRA or your Roth IRA. You cannot borrow funds and use that account as collateral for good reason. It's for your retirement. They should withdraw the rule. You should not be allowed to borrow money against your 401k plan. It's just a terrible idea. Because here's the other problem with it. If you've got a bunch of debt and you've got a 401k plan, and let's say that you've got 150 grand in your 401k plan at work, and you've got a bunch of credit card debt and you just can't get out of it, right? You file for bankruptcy. The 401k plan is protected under bankruptcy laws, right? The creditors can't go after your 401k plan or your IRAs. Those are protected. But the moment you borrow money against that 401k plan, that loan is now non-protected under bankruptcy laws.
That's exactly right.
And now you're liable for that loan as well. So there's no good reason ever to borrow against your 401k plan. It should not only be, look, I know there's people say, yeah, but I'm in this particular situation and maybe there's just absolutely no other option. People tell me that. I have never run into a situation where there was no other option, right? Bankruptcy is an option. Nobody cares about bankruptcy anymore. Back in the day, right? Back when there was, we had to pedal our cars around with our feet. If you file for bankruptcy, it was taboo. It was almost like getting a divorce back in the 60s and 70s. It was like, you're divorced, oh, it's terrible, right? You file for bankruptcy, what's wrong with you? And it was this terrible thing. And you could not get credit for 7 or 10 years. No, the bank, if you had filed for bankruptcy, a bank would not loan you money for 7 to 10 years. You were just not credit worthy. Nobody cares anymore. Ever since the turn of the century now, you file for bankruptcy 1 or 2 years and the banks are like, yeah, we'll give you money. So bankruptcies are not what they used to be in terms of having a bankruptcy on your status. It's better to have, in most cases, if you're in that kind of financial stress, and I'm not advocating filing for bankruptcy, I'm not saying that. I'm just saying that you're almost better off in a lot of cases just filing for bankruptcy and dealing with that impact for a year or two rather than tapping that 401k plan and messing up that potential retirement that you've got squirreled away over there.
Yeah, it's just about exploring all your options before maybe you make just like a knee-jerk reaction or decision. Yeah. You just want to explore all those options to say, okay, well, if you're looking at really, if you're having to take a big loan from your 401k plan to maybe, take care of some other financial obligations, or versus, maybe, considering filing for bankruptcy, that doesn't sound like a very fun situation to be in, period, right? But of those options, what would be the least painful to go through, or what would allow you to recover quicker, so that way you're setting yourself back up again to get on the right path for your future, right?
That's right. So, all right. Well, that wraps up the show for the day. Appreciate it very much. Be sure and like and subscribe to the channel. We've got a lot of stuff coming your way. Also, I've got a couple of articles coming out over the next couple of weeks, stuff we've been talking about here lately, economic recovery, trading rules, all kinds of stuff. So we've got a lot of good articles coming out on the website for you, realinvestmentadvice.com. While you're there, also send your questions, comments, emails. John and I are happy to answer them. So if you've got questions and would like us to talk about something on the show in particular, send us an email and say, hey, could y'all discuss this? You know, particularly if you're a parent raising kids and there's something that you'd like to would like us to talk about specifically to your family, and you have questions about it, we'd love to hear about it. We're always looking for new ideas to discuss here on the show with Two Dads on Money. And also, too, everybody's talking about the backdrop this morning. Yeah, John and I are going to take pictures of our actual kitchens. So we're going to... So we can actually do that. So anyway, thanks a lot for joining us today. Be sure and like and subscribe to the channel. We appreciate it very much. It helps us more than you know. And get by the website, realinvestmentadvice.com, and we'll see you back here tomorrow.